Hello guys, welcome back to the channel, best place for long-term stock investors. Hope you're enjoying your week so far. Now, before we begin, as usual, right, none of this should be taken as financial advice. Please speak to a professional if you need advice. What we're going to talk about today, three things. Recently, Daily Journal, Charlie Munger, his company, he had a meeting and there was a pretty good 2-hour interview on Yahoo. And so we're going to talk about what's exciting or like what are some of the important points that Charlie talked about. Next, we're going to talk about Sam Engineering and Kobay's recent quarter and what we think of it. Before we move on as well, just want to let you know we do own the stocks mentioned in this video.
It's been a bad year for stocks, especially at the beginning of the year. And if you want to figure out how to build that 6 to 7 figure portfolio but don't know where to start, you need a step-by-step method, we do have something for you. It's actually our free stock masterclass, and you can find the registration in the comment section below.
All right, John, let's start with Mr. Munger. Always, whenever he talks, there's going to be interesting stuff.
Yeah,
right?
and it was like, it was a back and forth, and yet there was a delay where Becky quick was sometimes, there was like Munger will pause for a while and then start stalking.
Oh yeah, I didn't realize that, you know why? Because I was listening at 2 times the speed.
Oh yeah.
It was pretty long, so I was like, but yeah, he does that, you're right.
Yeah.
So look, anyway, I think there are 3 important things that he talked. Actually, there's so many. Actually, everything he says usually is important, but these are the 3 that I thought, can make a lot of sense of what's happening now.
Correct.
Right? And I think the first one is why they asked, it's a Daily Journal meeting, but then people are asking why is Berkshire holding so much cash? And then in contrast with, I believe, Daily Journal, they're not holding as much cash.
And
right?
they're taking actually debt actually.
Yeah, exactly. They're taking some margin for whatever they want to do.
Yeah.
So, and someone asked him, why is it that Berkshire is holding cash, and things like that, right? Is he like worried about the situations? Do you remember what Munger said and what his thoughts are?
Not so much on the cash, because that for me was very similar to the explanations, what Warren and all, and the business nature. But I think his second point about money printing was, for me, because he cracked a joke.
Yeah, exactly.
He cracked the joke about, he's saying that, just imagine you are taking on debt and you're paying with your checking account.
Yeah.
So for me, that joke was like so dry. So the humor was so dry. But if you really understood what it was, it's actually like you are doling out money and then you're paying on steroids.
Yeah, exactly, right. But we'll go to that.
Come back to Berkshire skipping cash first.
I think, like, the reason I brought this up, we mentioned this a couple of times, I think, in previous videos. But what people need to realize with Berkshire Hathaway is that the size is too big. So, and it's very weird in stock investing, right? Because when more money grows, when your own money grows more, the opportunities actually shrink.
That's right.
So if you listen carefully to what Munger said, is that it's not that they're trying to time the market or saying that a crash is coming or something like that. It's that there's nothing in their universe where they would like to buy that is the price that they want to pay.
Yes.
Right? So there are a lot of companies that are great that actually they can invest in. It's just that they're not at the price that they want.
And also, if they do deploy their cash, because of the deployment of such a size, right? It's, you remember the joke that we used to tell each other about a company in Malaysia, and the CEO and the chairman actually joked and said that you can't distribute wealth by dividing it, right? So if we were joking that if Berkshire were to buy this company, the entire market cap, right, wouldn't even, by them deploying it, the entire market cap wouldn't even make sense to them, because it's such a big war chest, is it? So
exactly,
the point you made about the size is actually a detriment to them, actually.
Yeah.
And it's an advantage to us as small-time investors.
Yep.
I think Warren did say, and it related to the point about Berkshire keeping cash, he said, if he runs a 10 million portfolio, for him to make 50% is easy. But for him to run a portfolio of 100 billion or half a trillion, then to get 50% is difficult.
Yeah, exactly.
Yeah.
Well said, well said.
Yeah.
So, yes, let's move on to the money printing part, all right, USA and Japan. So, to set some context for those who didn't listen, yes, so those of you who don't know, basically, a lot of these money printing conversations now, they reference Japan a lot because they actually did it in a really intense way.
Correct.
Back in the 90s, and they've been doing it for 2 decades, essentially.
Correct.
Right? More than actually, probably 3, right? Depending on how you look at it. But one of the mysteries is that why is it that even though there's so much money printing, there's no inflation?
For Japan.
Yes. So, but there's stagnation, but there's no inflation, right? All the theories have been thrown out the window.
Yeah.
But yet, you do see in the US, inflation so far, right now, picking up.
Yes.
So that's a very weird thing, right? It's not something people would have anticipated. Charlie's point of view is that with Japan, they have a completely different society. When
Correct.
things get bad, right, they really tighten the belt and they have a much stronger pain tolerance. And so that's why when people get free money, corporations or whatever, they actually end up saving it and actually end up not doing anything with it.
That's why if you look at the chart, right, MJ, the more they print, the more the BOJ buys government securities, right, the more the savings, right, actually moves up also. So it's like you're printing, but it's saving. Whereas in the US, you print, there's a better likelihood that it's being spent to spur the economy. Whereas in Japan, and I think the other thing that Charlie brought up, which I think was a very good point, was it's a very monogamous. I think the word he used was monogamous society.
No, it's basically one race, right?
Yeah.
One monoculture.
Monoculture. Not
homogeneous.
Homogeneous. So I think what he meant was that the culture, behavior, and everything, it's more singular.
Exactly.
Compared to a country like the States, where you have all these different immigrants coming in. There's a very liberalized way of doing things. And look, I mean, if you draw parallels to how the COVID vaccination, people are more vocal about not getting vaxxed and everything in the US as compared to Japan. Japan is like, government say this, most likely you comply, similar to China, you see. So I think if you bring that to economic theory and as well as how the behaviors of culture, I think this is where you see what Abenomics tried to, I think, what was the name? Kuroda, the Japanese bank governor. Yeah, so they actually stopped. Apparently, they actually stopped, buying, the BOJ actually stopped buying government treasuries. And they wanted to see the impact because the new government coming in, they don't really believe in the way Abenomics used to work. So we'll see. It will be interesting times to see the tapering right now, as you can see, right?
Oh yeah, man. Man. We'll see, man. Really, we'll see. But the point, I think here, the big takeaway for me is that, theory only works in theory.
Correct.
Practice can be very, very different.
Yeah.
I think the last one I wanted to include in is actually that greed does not run the world, envy does. So what Charlie was saying is that today, we are living better than the richest man, I think, like 100 years ago.
Precisely.
Right? We are living better than Rockefeller, Carnegie, all these rich people back in the past, right? But dissatisfaction, discontent has gotten lower. And so he was saying...
gotten higher. Dissatisfaction higher.
Correct. Gotten higher, right? So he was saying, why it doesn't make sense when you got air conditioned. Rockefeller didn't have air conditioned.
Correct.
And so he said that the reason why people have gotten less happy or less satisfied with the economy is not because things has not gotten better, is that they are comparing. Right? I'm not happy even though I got a car when my grandfather didn't have a car because someone else has a better car. But what do you think of Charlie's analysis?
No, I love it. But at the same time, it's a double-edged sword because it's a capitalist system. The reason why all this envy and everything is created is because the capitalist world needs growth generation, revenue generation from all this. And You know, last night I was quite ironically watching the Netflix documentary about how Boeing fell. And the culture changed so much after the acquisition of McDonnell Douglas. And I was thinking about this statement as well because they were envious of the success of Airbus. And they wanted to do a lot of shortcuts in order to be able to beat the Airbus at the game that they used to be kings all this while. So if you talk about the TAM of the commercial aviation market, the TAM is growing. So you don't worry about how big the cake was. The cake was growing.
Yeah, absolutely.
Yeah, but then they were they were envious of how Airbus was beating them at the game because they always looked down on their European competitors and all this kind of thing. And then, yeah, so one thing led to the other. Obviously, I think a lot of people know today the 737 MAX and all that kind of thing. But I think it's a great statement. And even better is this, we as investors, right, while we are conscious about not being envious, and it's not easy to be, but at the same time, you have to realize the other facet is that businesses grow because of the world feeding on envy sometimes.
Yes. That's why it's a very internal point.
Yeah.
I think what Charlie is also trying to get at, because I read his other stuff also, is that there are many ways to go. One way to grow is through that envy, like, oh, he's doing better, so that he inspires me to do better. But I think what Charlie would say is that, yes, that's true, but it's not sustainable.
Yeah.
Because at some point, you just find some new guy who you deem is better.
Better than the Jonases.
Exactly. There was this story, this guy, I think he founded like multiple international companies. He's worth about $2 billion. So he went to this psychologist, and then the psychologist asked him about his life, and he said, yeah, you got a good family, you exercise, you have like all these different companies, you're so successful. And then I can't remember his name, but I'll tell you his story, and you'll probably be able to find out his name.
Yeah.
I said, why are you coming to me as a therapist, and what problems do you have and all that? Then he found out he feel like he's not good enough. Imagine someone worth $2 billion saying he's not good enough. But you know why he said that? Because his roommate was Elon Musk.
Insane.
So it's not sustainable, right?
Yeah.
I mean, if you're worth 100,000 today, they say, oh, that millionaire.
Yeah.
Then you're a millionaire, then you say that multi-millionaire. Then you're multi-millionaire, that billionaire.
Yeah.
Then you're the billionaire or that multi-billionaire. So I think that because he's so old, I think that he foresees like this sort of trajectory. And so it's far more important to have, you know what Buffett always say, internal scorecards.
Yeah, internal scorecard, yes.
Right?
Yes.
And in practical terms, it means, right, it doesn't really matter so and so what returns your friends get, what returns your family or so ever get. It's actually what you want to achieve, and how do you better yourself by comparing yourself to internal scorecard, like what were you before?
I think the struggle for a lot of people is this. I know it sounds a little bit philosophical to for people hearing our discussion. Is this the problem? Is a lot of people don't know how to create an internal scorecard.
Yeah,
and I think that's something that that's why you see a lot of investors. I mean, we come across a lot of investors start comparing on that. I think for the application of it, a lot of people don't know how to benchmark an internal scorecard. I think that's
absolutely true.
That's something that I think for me, it's something very personal to everyone listening, and you have to kind of figure it out. Get guidance on how to figure it out.
Yeah. If ever there is one advice to help them discover that, or to, because I think before even like them discovering an internal scorecard, it's whether they want to discover it.
Precisely. There must be a motivation, internal motivation.
So here's the motivation. You won't look forward to the misery of not having an internal scorecard. That's what I'll say.
Yeah.
So let's move on. All right, guys, if you didn't know, everyone watching has a chance to join our internal exclusive research team. And the way you do that is by sending us a research report of a stock that you like, or maybe even if you don't like. Now, the key thing is that you're not going to just send us some of the basic information like the financials, which we already can find. What we want to see is your insights, your ability to analyze the stock as comprehensive as possible, right? What do you think of the management? What do you think of the future plans? What do you think the potential of the company? Some of the qualitative stuff. And of course, what are some of the quantitative stuff that you've discovered about the company that maybe the ordinary investor won't find? So if you want to hop onto the research program, and if we like your report, then that's how you can get into it. So to send your report, send it to this email, and make sure you send it in a Google Doc or a Google Excel or Sheets, right? Google Sheets form, so that we can look at it live and edit it and ask questions as we go. Okay, John. So now we move on to SAM Engineering, latest quarter. Now I did pull up some of the financials. Obviously, it's been a really good quarter. 9 months and then 3 months as well.
Yeah.
I think the quarter-on-quarter basis is like a 50% more. It's a doubling.
Yeah.
Essentially of the profit. However, when you are looking at the cash flows, it seems to be not so good.
Yep.
And a lot of it is because of the inventory build-up and trade receivables. Now, assuming I don't know much about this company, and I actually don't know much about this company, it's actually not too negative, because a big chunk of it is essentially inventories. And
Correct.
so they're just anticipating some sort of build-up, I guess, for their business. And that's why inventories is there, and I don't think it's that bad. But what do you think of SAM Engineering?
I think you look at it this way, the inventory actually tripled.
Yep.
And if we understand the aviation industry and also the semiconductor industry, a lot of it is what I call unbilled sales. So there are certain practices within the industry that they actually send the equipment or they send the product over to the customer, and they let them buy it off, in a sense that only if they're happy, only then they buy it off. I don't know whether they categorize that as inventory or maybe even receivables. Most likely it's receivables. But the build-up is, for me, two-pronged. One is that. The other prong is because raw materials today, especially for industries like semicon,
Correct.
is very, very difficult to secure. And I think they are just securing that supply chain in order to, they foresee, and actually if you look at the investor presentation not too long ago, they foresee a spike in opening up the sectors, especially aviation, and they want to,
and this ties into like whatever is happening with like things like chip shortages and also commodity prices really going up.
Precisely.
So not only is it harder to secure, it's also now more expensive to secure them.
Yes. And I think it's a great strategy. I think SAM has, I would say, been a lot below the radar by a lot of people. And I think well management, great management. Yeah, we won't go too much detail, but I think don't look at figures only and at one point or a snapshot. Always think behind the business. Why are these numbers like that? I think that would be the advice I would give.
Correct.
Yeah.
Enjoying the video so far? If you are, remember to like, comment, and subscribe. Click on the notification bell so that you know when new videos are out fresh. Okay, it's time for Kobay. Hey, not bad.
It's not beef, huh?
Yeah, it's not.
It's not beef.
I'm talking about my rhymes, you know. Kobay Technologies. I always call this the one that got away for me because I had enough information to act on it, and I didn't. But it is what it is. I think it's down like 15%, 20% the stock from all-time high. And but they've got a great quarter, right? A better quarter than nearly triple.
Yeah.
But a better quarter than SAM Engineering. So it's again beautiful.
Yeah.
But again, they have the same thing. Now they didn't report. It's very similar to this thing, SAM. Their operating cash flow, well, it's not as bad. The operating cash flow got half, whereas SAM went from positive to negative. And a lot of it is in what we call change of current assets, which basically it's, what the working capital is. So a lot of it, now what's interesting and what's slightly different from SAM is that the cost of the cash flow dropping is not as skewed. So if you remember in the previous one, the skew was something like 120,000, right?
Yeah.
If we go back. Yes, so you can see clearly, right, that inventories actually plays a slightly bigger role versus trade receivables.
Yeah. This one, trade receivables was bigger.
Yeah, correct. So this one, I mean, by percentage, inventory is bigger, but by quantum,
It's
trade receivers is about 30 million, 31 million, and then inventories is about
36 million.
double 30.
Yeah, double
25.
size. Yeah.
25, 16, yeah, about 20 lah. Yeah,
Yeah.
20, right? So yeah, how will you respond to this, John?
I think it's rather than look at it in isolation, I look at Kobay, Sam, and all the other precision metal guys, the other semiconductor industry. I think if you've read, I think 2 days ago, another Chinese chip IC design company just plowed in another 250
Yes,
million in
correct.
Penang. So more importantly is how long will this cycle last? You have to remember semicon electronics, it's a cyclical industry. My personal opinion is this is something that is accelerated because of COVID.
Yeah.
This is a progression that was supposed to happen over the next 5 years, but because of a lot of the working from home, acceleration of convergence of acceleration of a few things, automotive, work from home devices, change of consumer behavior. This has actually now made the bull cycle of the semiconductor slightly longer. And rather than just looking at the share prices of a lot of these companies, I think I look at the demand and the supply of the value chain. And from there, I think looking at it, it's an opportunity if you are buying it at the right price. If you're buying it at the right price. And also more importantly is that it's high time people understand the value chain in order for them to secure the best investment opportunities. Because a lot of times people just think, tech is such a big word. But when you look through the ancillary services that these guys actually provide, these are B2B businesses that, you know, we were having this discussion before, MJ, and I think it was my my sharing on, what's this, the financial coconut or something? Yeah.
TFC, yep.
Yeah. A lot of times people buy brands. They invest and they like to buy brands. Nothing wrong.
Simple to understand, yeah.
Very, very easy to understand. But more importantly, if you want opportunities, you have to find those that do not have do not have a front-facing brand, but important to the value chain. I think that is how it was.
Yeah, I think that's definitely the case with Malaysia. And in fact, I think we should do our best as, you know, people who are sharing all this in public to be more accurate about what the words we use. So for example, I think we should all abandon the word tech already.
Yeah, exactly.
To be more specific, right, I think this is a much better word. And it's really semiconductor manufacturing.
Correct.
That is way more specific.
Correct.
They use tech is like, you know, it's not really...
No,
really
great point. Great point.
Yeah. I mean, to be fair, I mean, certain companies like Frontcan, for example, doesn't really fit there because it's more of a service. Or KSM is more of a service, right?
Correct.
So yeah.
But it's a service to the semiconductor manufacturing industry.
Correct.
Yeah.
So for me, that is way better, right? Semiconductor manufacturing. So yeah, guys, you know, think of it that way now, right? It's still a very physical type of business.
Correct.
It's still a very labor-intensive type of business. So don't, like, whenever people think tech, right, it's like they think software or Malaysia is not good enough. 2, we don't need to be good in that department. We have other countries to do it.
Yes.
And I think with like software as well, it's a lot more winner takes all. So if you've got one good software like Microsoft, the whole world uses it.
Yeah.
Right.
Yes.
So any thoughts about like the semiconductor cycles and these two companies before we move on to the question of the week?
No, not really. I think we've mentioned it many times, but for first-time viewers, I think spend time to understand the value chain, put it this way. And obviously there's ways to do it. This video, I don't think I would do justice to it if I explain it here. But more importantly also, if you choose to do active portfolio management for yourself, it's beneficial that you look beyond just the share price. I put it this way.
Yeah. Basic but important.
Yeah.
Okay, John. So question of the week is from Mr. Henry Braun. This is the second time we are getting his questions because he asked really good questions. And that is free cash flow or operating cash flow more important?
Serves two different purposes. I think the short answer would be operating cash flow for me, in very layman terms, is business as usual. Free cash flow is business as usual plus expansion to have surplus.
Yeah.
What are your thoughts?
Well, I think it all depends on the stage of the company. So let's take, for example, the semiconductor manufacturing sector. And this was something I just thought about recently only. A lot of these companies have what we call a pioneer status, which comes with a caveat that they need to spend money, right?
Correct.
So if they need to spend, it makes sense for them to spend because if the government is giving you a tax incentive and you're not spending, then what is the point, right?
Exactly.
So they spend money. Why? Because they can foresee growth. So they build a factory, they build hubs and all these lines and whatnot. So for these sort of companies, operating cash flow becomes more important because they have to spend a lot today for things to happen in the future.
Yes.
And so you need to check the operating cash flow that whenever they spend, whether or not it grows or not. So in that case, operating cash flow is more important. But in a company that does not need to spend a lot of money, they are in what most people would consider a more mature stage, then those sort of companies, free cash flow becomes more important because now they don't have to spend. They have to rely on some other things like, or they don't have to spend big rather. They have to rely more on things like being efficient in the company. They have to be more, maybe the marketing has to be better. Like the Nestle's of this world, they need to spend, add money. That's about it.
Yeah.
So that needs a lot of product consistency, whatnot.
I think key to what you just said is this lah. Rather than saying which metrics is more important than other, I don't think that should be the
Correct.
way we should look. The way we should look at it is that, in essence, how does these numbers matter to the business?
Yeah, exactly.
The different natures of the business will dictate at different phases of the business how the company is being run. Is it being run efficiently in the sense that it's growing?
Yeah.
Is it being run efficiently in the sense that if it's already reached a point where they don't need to do any more expansion, then you get you spill free cash flow. But at the same time, if free cash flow is negative, and a lot of people say, "Oh, free cash flow negative." Buffett say free cash flow is investors. Why is it negative? What is it in relation to the business is negative? I think because a lot of times I think we get this kind of questions. These metrics more important than this? This ratio more important than this? I think. Take a step back, guys. It's like, how does this ratio relate to the business and why does it matter?
Yep.
Then only you get a very clear example of...
Then you know which one to focus on more.
Exactly. Because I don't want people to fall into the fallacy. I only look at operating cash flow. That's it. But why? At what stage? I think that's the more important question to be answered.
However, I would add this, okay? I think regardless of the stage of the company, always pay attention at the beginning to the operating cash flow. Because no matter what, if for those of you who don't know, operating cash flow is a derivative of, free cash flow is a derivative of operating cash flow. So that is a base, that is showing you how much the company is actually making in cohort cash. Yeah. So great question, Henry. And guys, glad you made it to the end of the video. Remember to share with your friends and followers on Facebook, Instagram, even TikTok. And see you in the next video.